I actually think they are right. And I actually do think inflation is coming. And I'm talking about over the next few months because of tariffs. You're starting to see the beginnings of that inflation show up in some of the higher frequency, internet scraping things like Trueflation and Price Stats. They measure millions of online prices and aggregate them into like an inflation index. And they've been moving up for the last 5 or 6 weeks. Now, it didn't show up in the May report, but the June and July report, I think they could very well see those numbers show up in those reports and start to see inflation move higher. So I think Powell is right that inflation could be on the march up, and the Fed, it wouldn't be appropriate for them to be cutting rates with inflation going higher. You could look at, the Wall Street consensus that this is a one-time rise because of tariffs, and then everything would settle down after that. And there's a reasonable argument to be made for that. But that assumes that we're done raising tariffs and that we don't see more rounds of tariff increases, later this year or next year. And also, later on in the press conference, Powell talked about unanchored inflation. And this is where I'll diverge with him a little bit. I think there's some evidence, and the Cleveland Fed has laid this out a little bit, that when companies are given the opportunity to raise prices because of tariffs, they raise all prices. And that's what unanchored inflation is. And, give them an opening and all the prices go up. And that's what I think we got to be very careful of in watching over the next few months. Which prices are going up? Are they just the narrowly ones that are just because of tariffs? Or are we going to see prices across the board start moving higher because companies think that they could get away with it? If they do and we get unanchored inflation per the Fed, that would not be desirable, and that they would have to start to combat that thinking. I think over time yields are going to go up, and whether or not they're going to go up in the next month or two driven by tariffs and higher inflation remains to be seen, because the way I'm looking at the bond market right now is it's broadly at its fair value levels. I disagree with the Fed. I think that around 4-ish% on the funds rate is neutral, and they are around 4-ish% on the funds rate. I think that neutral on the 10-year and the 30-year, just to go to the other end of the curve, is around 4.5 to 5, and that's exactly where they're at. So the market is not undervalued. It's where it should be. So if you wanted to short bonds, you're saying that the fair value of bonds will move higher. You're not shorting them because they're rich or, that they're overpriced at some point. But I do think the fair value will move higher. It's just that the caveat or the warning I'll give is it might take a little more time than people think. The 10-year and 30-year, I think they'll punch through 5%. That's my expectation, but not maybe by the end of the summer. I wouldn't be shocked if they did, but I don't want to narrow myself down on both, a level and a time. I'll go with the level and say it's going to get there. Maybe it'll take a little bit longer, maybe it'll take shorter, but I don't think you should be looking at the idea that the bond market's going to sell off right away based on tariffs going up. It will, because I think the economy is going to be better, and I think inflation is going to be broadly higher, but not immediately. I would say that the economy is, I'm going to sound a lot like Paul here because I'm kind of aligned with him for the moment. It's broadly okay. There are some issues, especially in housing. There aren't really any cracks that I see in the labor market. I know people like to say that. And then there's a multitude of labor market statistics, and they'll point to one or two of them like continuing claims and say there's your sign of cracks in the market. But there's always one or two labor market statistics that say that, always. So you need more than that. You need more that we don't have it. So I think the economy is in an okay place. And if we do get drifting higher inflation and that nominal growth in the U.S. continues up, I think what you'll see interest rates go. Now, can that change? Sure. The Iran-Israel war can change it, or some other type of thing could come up and spike oil prices or anything else. There was an economist in the 1970s named Rudy Dornbush at MIT, and he coined a famous line: economic expansions do not die of old age. They're murdered. Now, what that means is that don't look for the economy to roll over. Don't look for the economy to pop. It doesn't do that. What causes a recession is some event, like a COVID shutdown, scares everybody. They stop doing things, and then the economy contracts. We're in an environment where that's very possible to happen, but it spikes oil, spikes gasoline prices, and that's your retrenchment. That if you wanted to talk about what causes people to stop economic activity, eye-popping pump prices. Now, we don't have that. We're at $78 on crude oil prices. We're not at 120 or 150. And if we stay at $78, we probably won't have that. But when bombs are flying and we're talking about the U.S. getting involved in attacking a country of 92 million people, which has become a thing now, the population of Iran, anything is possible. So that's why I think that these markets are getting very nervous and worried right now. There's two things to think about with that deterrent. As it's been unfolding now, the price of oil is up about 15 or so percent since the war or the escalation started, but it's not up 50. And the reason is because what Israel has been avoiding is really damaging a lot of energy infrastructure. If the U.S. gets involved, they might also avoid, or probably will avoid, damaging energy infrastructure. Now, there's an argument to be made that one card that the Iranians could play if they want to suck the U.S. in is destroy their own energy infrastructure, so we try to go in and stop them from doing it. So that is a concern right now. We don't know what they're going to do, but I don't think that Trump or the Israelis are going to green light, bombing pipelines or oil terminals in Iran that would have implications for the long-term price of crude oil. I think what the market is pricing in is the risk that something could happen, not that the reality has actually come forth. Yeah, I mean, beyond crude oil, what you could also see is, closing the Strait of Hormuz, adding into that the Red Sea and the Suez Canal. What you'll see there is shipping has become more difficult business, a more expensive business, a riskier business. That's going to show up in all the prices because everything that we buy, the things we buy, most likely come from another country. Now, I know Trump wants to change that with tariffs, but it ain't changing tomorrow. And so those prices are going to have to start to reflect the cost of transportation, and the cost of transportation is definitely going to go higher. After that, then the next question is, where does the U.S., you asked about any spikes in the bond market or anything. The big question in the bond market, away from the traditional what's the Fed going to do, what's inflation going to do, is what's the appetite from foreign investors for U.S. securities. The dollar has been falling, our interest rates have been rising, and it hasn't been dragging people in. But interestingly, the data is not showing that foreign investors are abandoning our markets. We just got the Treasury International Capital Report for April. Foreigners were buying at least through the month of April. We've seen a whole slew of auctions in the month of June. We had a bad auction in the month of May, the 20-year auction, where people thought that was a signal that foreign investors were abandoning the bond market. But since then, we've had a whole slew of very good auctions where we've seen very good foreign demand for those auctions. So it's not yet, but there is still that concern with the falling dollar that foreigners will start to abandon the U.S. And I think that is also going to be weighing on the bond market as we go forward. Ironically, I think that the bond market is going to have a place for it. I've been arguing that when you say the word investors, let's talk about the longer term, right? Not just what's going to happen in the next week or two. I've been terming these the 4, 5, 6 markets. That over the next several years, cash will return you 4%, bonds will return you around 5%, and stocks, because of their high valuation, will return you around 6%. So cash and bonds will be competitive investments in stocks. Even though yields will go up in bonds, there's a bigger coupon on them right now. And that's why I think that they're in that mix. Why is stocks only going to return you 6%? They've returned 20% for the last couple of years. It's because of valuation. The stock market is at a very high valuation, well over 20 on the forward PE ratio. Does that mean overvalued markets have to fall? No, I don't think they have to fall. When you buy an overvalued market like the U.S. equity market, what you're betting on is lots of things going right. Well, when you're having a war, when you're having all tariffs and the uncertainty about tariffs and what that means in the economy, potential for inflation and higher interest rates, it's almost impossible to get lots of things to go right. That's why I've argued, why are people rotating into Europe? Because European stocks have so badly underperformed U.S. stocks for many, many years. They've got very good relative valuations. When you buy cheap stocks, you only need a few things to go right for them to go up. Now, the problem with cheap stocks is they're cheap for a reason, and those few things almost never occur. But right now, I think people are saying, I'd rather take my chance with Germany because it's such a cheap market, because it hasn't done anything for years, or France, than to take my chances with the U.S. or the NASDAQ, which has been powerhouse performers. That's why I think you've seen those rotations. So looking past the noise that we've seen, and hopefully, there is a soon and peaceful resolution to this. I think that when you look at these markets, you're going to find cash, bonds, and stocks are all going to be fairly competitive with each other because of the rich valuations. Nothing wrong with buying a rich market, but what you're doing is you're betting that everything is going to go right. And with war and tariffs and everything else, that's a very long shot. I think that everything will go right. Gold is definitely a safe haven play. It's the more traditional safe haven play, and that's what I think we've seen from gold. Is even with its Asian central bank buying, that is helping pushing it higher. Bitcoin is a little bit of a head scratcher. It kind of acts like both a speculative play and a safe haven play. What I mean by that is price at 104,000 is not that far from its all-time high, but neither is the stock market. The stock market's still about 3 or 4% from its all-time high. So is Bitcoin, and Bitcoin seems to go up and down with the stock market or the NASDAQ, so there's a correlation there, making it look like it's a speculative animal. Why do you buy Bitcoin? Because the stock market's going to go up. It's going to go up more. When do you sell Bitcoin? When the stock market is going to go down, because it goes down more. That's not a safe haven play. But if you make the argument for why Bitcoin, you are making a safe haven argument, which makes perfect sense. It's just it doesn't trade that way, at least right now. But, I still think at some point in the future, maybe it's years from now, it will break this pattern of acting like a speculative vehicle and act more like a safe haven vehicle. It's not there yet. So if you're owning Bitcoin, you're kind of betting on the S&P going up. And as I was saying before, I think you're betting on lots of things going right. And that's not really in the cards for the moment. Copper, base metals, pretty much everything else. Commodities are an input process. They're not really an asset class. So if you're going to say, what is the price of copper? Well, part of the price of copper is the energy required to get it out of the ground. And if energy prices are going up, so will copper prices. So will corn prices, because the price of running your tractor in the field is going to go up. Energy has an impact on all of those. But will we see price of copper or lumber or corn or something like that go up on its own because of excess demand? Probably not, because I don't know if higher energy prices will produce excess demand. Now, I'm talking about $80, $90 oil. I'm not talking about $150 oil. $150 oil is a different story altogether. That's a crisis area. For the end of the year, for the next 6 months, I think that all the safe plays are going to be probably the play to go with. It's going to be energy. It's going to be gold. It's going to be, defensive plays like money market funds. Why do I say money market funds? Because you're going to go up 2% by the end of the year. You've gone through 3 thrill rides to get a 1% gain in the stock market so far for the first 6 months of this year. So I think that those types of defensive plays are where I am right now. Now, if there is an all clear signal or something else that comes, I'll get more aggressive. I think at the least right now are probably the most overvalued companies, and I'm going to point towards the Mag 7 right now. The Mag 7 have got to see lots of things going right, and that means that customers are going to say, the hell with all this other news, throw money at AI, throw money at AGI. Now, they've been doing that, but there might be some kind of a pullback in that. And again, it's all about the valuation. When you're buying a lot of these highly valued Mag 7 stocks, you're betting everything's going to work. And everything's going to work on a tight time scale. And if it doesn't, then you're going to run into trouble. Now, everything might work eventually, but it might not work immediately. And I'll give you one really quick example. Amazon. Oh, I should have bought Amazon in 1999. Boy, I would have made 50x on my money or 100x on my money, depending on when you bought it. And that's true. However, 1999, when everybody was saying, buy Amazon, this thing called online retailing is coming in, they're going to be a leader in it. They were 100% right in 1999. But in 2013, the price was at the same level. So you bought Amazon, we're going to have this online revolution, and you made 0 in 14 years. And then it went up 100x. And that's what you have to be careful of with a lot of these technology plays. Because what happened? We had a recession. We had a financial crisis. And that kind of got in the way. But once we cleared from those, then the flourishing of online retailing really took off. Are we going to have AI? Absolutely. We're going to have AGI? Absolutely. And is it going to be transformational? Yes. But is it going to be transformational in 26 and 27 or 2040? Because if it's 2040, you could buy these stocks now and wind up a decade later with no money. If it's going to be 26 or 28, you could buy these stocks now and wind up with a lot of money. Yes. I'll make the play that it's going to take longer than people think it's going to be, but eventually we will get there.